everybody, and welcome to this monthly short video, Economic Impact. 2 weeks ago, I was with Dr. Weiss for a special edition of the vaccine. We're back today with our chief economist, Stéfane Marion. Hello, Stéfane.
Good morning, Martin.
As we discussed with Dr. Weiss, the most important thing for the reopening of the economy is the vaccination campaign, and we have to admit we're doing quite well, Stéfane.
Yeah, fortunately, things are improving. We can see that as of May 9th, we almost have 40% of the population, Martin, that has been vaccinated at least once in Canada. So that's great news. And I would say also that what's also encouraging is that the rest of the world is getting vaccinated. So I think by and large, these are very important dynamics. And from a Canadian perspective, we can see that the pressure on the health system is abating. When we met last month, there was a resurgence of cases that in the ICU across the main provinces that made us a little bit more concerned. And now, a month later, we're stabilizing. And that is, I think, fantastic news for a reopening of the Canadian economy in the second half of the year. And as I said before, on this slide where we look at the developed economies, it's a trend that we're seeing where the vaccination campaign rollout is having an impact on new cases that are coming down and numbers of people that are dying from COVID is also significantly coming down. So that's great news. However, Martin, we can't be complacent. We know that elsewhere around the world, things are a bit more complicated, particularly in certain emerging economies such as India, where we're talking about 400,000 cases a day and 4,000 people dying every day. So clearly that could be a concern for the propagation of new variants. But fortunately now, I think the good news is that, a number of countries are sending help to India. So I think the baseline scenario calling for a reopening of the global economy for the second half of the year is still on track.
And let's look specifically at this economic expansion and especially the difference between emerging markets and developed economies.
So we know there's a bit more pressure in emerging markets, Martin. So clearly on this slide, we can see that manufacturing activity in the advanced economies is surging. For the advanced economies, it had slowed down, but it seems to be picking up over the past month or so. And the good news, Martin, is that though they have slowed, they're still expanding. And you know how important that is. That's 60% of global GDP that's accounted by emerging markets. So I think what this slide shows, Martin, is that it's a widespread economic expansion that is still on track for the months ahead.
And one thing that we haven't seen since the beginning of the pandemic is the fact that profits are now really back and quite impressive.
Yeah, so economic activity is obviously having a big impact on profitability, and we did not present this week a chart on the global stock market, which is
it's a record.
It's at a new high again this month, Martin. But we've said before that it would not remain at a new high if profits would continue to trail. And the good news is profits are finally growing again. And note that, Martin, it's the first positive growth that we're seeing since the start of the pandemic. We're talking about 3% globally, but for emerging markets, it's around 6%. So again, great news, because without profits, you can't keep global stock markets on an uptrend indefinitely.
We have to talk about employment. We had some disappointing news this week, but we need to put this in the bigger perspective.
Okay, so obviously, if you have a relapse in labor markets, profits are not going to necessarily do very well in the months ahead. And people were very disappointed after the last U.S. jobs report. But I have to say, Martin, yes, it was below expectations, but at least it's still trending up for full-time employment, and that's key to generate your profit growth down the road. In Canada, you can clearly see a relapse in that red line. Should we be overly concerned? I think that's only a reflection of the temporary shutdowns that were ordered in certain provinces in Canada. I'm confident that with the vaccination campaign that's doing well right now, we will have a reopening of the economy. So I expect full-time employment to rebound as soon as next month for Canada, or the next couple of months, if you want to give me a chance on that one. But what's important on this slide is to show that Canada retains an advantage on the U.S., where full-time employment is still, almost 4% below the pre-pandemic level. So clearly more needs to be done from a U.S. perspective on that front.
And let's look at this more specifically, Stéfane, because it's a very important part of the story. The situation in the States for employment remains very difficult.
Well, keep in mind that the Federal Reserve has a dual mandate, right? Unlike Bank of Canada, so they have decided that their main focus should be on returning employment to its pre-pandemic level. And as you can see on this slide, the red line shows you there's only 57% of Americans that have a job right now. This is lower than the lowest that we saw after the 2008-2009 recession. So what the Fed is saying, and what they said again over the past couple of weeks, is to say that until employment is back to its pre-pandemic level, that's 10 million jobs, Martin, they're going to continue with quantitative easing and keep interest rates very, very low, which means that you're looking at real interest rates, so interest rates adjusted for inflation, that will remain in negative territory for the foreseeable future.
And when you have a scenario like this, what happens?
Well, if you have central banks that are committed to keeping interest rates below inflation, inflationary pressures are building up, and you can see right now that inflation expectations are at roughly 2.5% in the U.S. for the coming years, which is substantially higher than we were at this time last year, almost zero. And we're back to where we were in 2013 or so. But Martin, importantly, we're not talking about hyperinflation, but clearly this is a regime change from what we've experienced over the past decade.
And we're getting a lot of questions, Stéfane, about the rise in copper, the rise in gold, Bitcoin. A lot of stuff is going up.
Martin, if you're a central bank that is committed to keep interest rates below inflation, and you're willing to welcome somewhat higher inflation, investors are reacting, and people are saying, listen, we want tangible assets or alternative assets. So the price of Bitcoin, everybody's been speaking to Bitcoin recently, is up, yes, but look, the price of lumber is surging, a reflection of higher demand for tangible assets, such as real estate assets. Look at the price of copper, look at the price of bullion, which was down a bit earlier this year, but is coming back. So people are reacting to this negative interest rate commitment by bidding up alternative assets.
And even real estate, right, up around 10% globally?
Yes, within the OECD nations. I mean, I know we know real estate prices are surging in Canada, but this is a reality across the OECD. Yeah, so we're talking about double-digit price increases for real estate assets. So yes, this is what happens when you commit to keeping rates below inflation for the foreseeable future.
And Canada should do particularly well in this context. We've talked about it before. Now we're seeing it.
Well, if you're Canadian, you could say, what are the alternative assets? Well, even some type of financial assets in Canada will do well in a world where there's slightly higher inflation. Case in point, for the Canadian economy, we're seeing profit revisions that are the best in over a decade. So upward earnings revisions. Over the past 3 months alone, Martin, profits have been revised up by 9 percentage points. This is year ahead profits. So this is a formidable revision. We're actually outpacing the U.S. in terms of earnings revision. So that's good news for the Canadian economy.
And a consequence of that is the Canadian dollar. Finally, after 5 years, international investors are looking at Canada again.
Well, we've been saying together since the start of the year that it wasn't normal for investors to shun the Canadian markets in a world where inflationary pressures might be building up. And we said, after shunning the Canadian markets for many years, they have to come back. And clearly, there's a bid on Canadian assets right now, and we're clearly seeing the impact on the Canadian dollar, which is near 83 cents right now, a level that has not been seen since 2015. So we can't have it all from a Canadian perspective. We can't have a surging economy, higher commodity prices, and a depreciating currency. No, the reflection of this improvement in the Canadian backdrop is a stronger Canadian dollar. We have to live with that, I think, for the next few quarters.
And Stéfane, it's not only because Canada is doing well, the stance of the Fed is also impacting the US dollar, is not doing well against a basket of currencies.
It's a good point, Martin. I mean, the Fed's policy right now of keeping interest rates below inflation means that you want to depreciate your currency, and the US dollar is actually down versus 26 of 31 currencies. So yes, it's a widespread US dollar depreciation that we're seeing right now.
And to conclude today, what about financial assets?
Okay, so financial assets, I say from a Canadian perspective, you won't do well, and I would warn people that when there's a lot of volatility on the currency front, it will impact the performance of your portfolio, depending if you have exposure to foreign currencies. And you can see that year to date, as of May 8th, if you are Canadian investors, you look at total returns on a Canadian dollar basis, and you can see that Canadian dollar, the S&P TSX is outperforming other indices globally, Martin. We're talking about 12.8% total return year to date. The S&P 500 has done well in US dollar terms, but if you translate it in Canadian dollars for Canadian investors, it's an 8% return. So by and large, Martin, be prepared. Large currency swings will impact the performance of your portfolio, but as a Canadian, if you're looking at the potential edge to somewhat higher inflation, I'm not talking hyperinflation here, but somewhat higher inflation, maybe in a 3% range, the S&P TSX is not a bad place to be.
Excellent. Good conclusion, Stéfane. I think that inflation remains a top risk, but we're not talking about hyperinflation. And there's a very different picture for a Canadian investor and a U.S. investors when you factor in employment as well as the value of the currency. So thank you very much, Stéfane.
Thank you, Martin.
Thanks for listening. We'll be back in 1 month. And meanwhile, take care. Thank you.